Welcome back everyone to Economics Wise. Our course for today is Introduction to Accounting. The topic before us today is the Introduction to Incomplete Record and Single Entry. Before I proceed to today's class, I would like you to like, comment, and subscribe as we'll be posting more on accounting courses. On our next slide, we're made to understand the basic concepts to aid our understanding of the incomplete and single entry. And these concepts include the double entry principle, ledger, additional capital, drawings, accruals, prepayment, statement of affairs, cash and bank summary, statement of financial position. And I believe that with this basic foundation and background, we'll be able to tackle any further questions on the incomplete and single entry principle. Now, on our next slide, we are starting with the double entry principle. For every transaction, it has a dual effect. That is, every transaction has to be recorded twice in order to form a balanced equation. So this principle is referred to as the double entry principle. Now, the rule states that for every debit entry, there must be a corresponding credit entry, and for every credit entry, there must be a corresponding debit entry. Now, this simply illustrates that for any transaction, there is always a dual effect. It has two sides. One is either giving and one is receiving. One is either debited while the other will be credited. Now, the basic rule here is debit the receiver and credit the giver. The receiver is the person receiving this money, while the credit creditor or the giver is the person giving out. So we debit the receiver and credit the giver. We debit incoming and credit outgoing. We debit expenses and losses, and also we credit profits and gains. On our next slide, we understand what a ledger is, and we say a ledger contains the permanent records of assets and liability, income, expenses, and the equity of the business. Now, when you talk about a ledger, it's simply a T-shaped table in which you have a debit side to the left-hand side and you have a credit to the right hand side. Now it contains the permanent record of assets, liabilities, income, expenses, and equity of the business, and this information are usually computed from the subsidiary books into the ledger. So the ledger is simply the permanent location where it is located permanently. Now we have three different types of ledger. We have the personal ledger, private ledger, and the general ledger. From the word personal, we're referring to customers, and we say it keeps record of all customers' transaction divided into the sales ledger and the purchase ledger. Number two, we have the private ledger, and from the word private, we relate it to privacy, and this contains those confidential transactions like the drawings account, the current account, or even the investment account. Now, the third one on our list is the general ledger, and we said the general ledger is further divided into two. We have the real account and the personal account. Real accounts are accounts for tangible assets like furniture and fittings, land, equipment, machineries, plant. Those are accounts for tangible assets, while personal accounts are account that deals with individual, corporate bodies, partnership, anything that relates to an individual. On our next slide, we are made to understand some basic concepts to aid our full understanding of incomplete and single entry. And the first analysis is the additional capital. Additional capital are capital advances or equity contribution to the existing capital. For every setup or for every startup, there is always a certain amount of money that is brought to fund the business, and this is known as capital. But additional capital are capital advances which are added during the course of the business. Drawings are expenses that are incurred by the organizations on private affairs that are not related to the business organization. So this drawings, however, reduces the capital balance. Accrual concept states that income should only be recognized when they are earned, not when they are received in cash. That is, for every income we earn, We should only recognize it when we've earned it and not when we've received it in cash. Therefore, accrued income are said to be assets to the business. When income is being owed to the business, it is said to be an asset to the business. However, expenses should also be recorded when they are incurred and not when they are paid. When we incur expenses, they should be recorded, they should be noted, and not just when they are paid. Therefore, when we talk about accrued expenses, they form liabilities to the business because we've not paid for for this service, but we benefited from it. However, we move on to prepayment, and we say prepayment. Prepared expenses occur only when payment has been made for a service, but the benefit has not been derived. I've paid for the car, but I've not received my car. That's the prepaid expenses. So these expenses represent assets to the business. However, prepaid income are income that are received in advance of service. Now, let's assume I'm the car dealer and I received the payment for the car, of which I have not delivered the car. It's a liability to me because I've received income and I've not rendered the service. So our next slide also talks about the statement of affairs. Why do we prepare the statement of affairs in incomplete record and single entry? The single entry explains the system of account that does not provide or that does not go in line with the double entry principle. Now, that is only one part of the account is being recorded. It is not always in double folds. So the statement of affairs is a statement that is designed to give an overview of the company's financial position and in order to ascertain the capital under the single entry system, since all transactions do not follow the double entry principle. Now, incomplete records simply describe a system whereby there are hardly any records are maintained, and they are inadequate. These records, however, are inadequate to facilitate the preparation of the statement of profit or loss. We can't know if the business organization is making profit or loss. However, this is due to incomplete record. But in a situation where we are here to correct this incomplete record to make it balanced, then we can move forward to prepare a statement of profit or loss. With this basic understanding, I'm 100% sure that you are able to tackle every questions under incomplete record and single entry. Please like, comment, and subscribe to the channel in order to be updated for future videos. Thank you very much. I remain your host, Miriam Ibrahim.